Today, we're talking about the invisible crash. And we're going to get to the bottom of why the economy feels so incredibly wrong right now.
I mean, have you had that feeling? You see the headlines, you hear the experts talk, but then you look at your own bills, your own bank account, and you just think, why is there such a massive disconnect here? Well, let me tell you, you are not crazy. And we're going to get right into it. All right, so the first part of the answer, it's actually pretty simple, but it's also really unsettling. The economic dashboard, the one we're all told to watch, well, it's lying to us.
Okay, so on one hand, you've got the official story, and it paints this really rosy picture, right? They're saying unemployment is low, GDP is growing, everything's great. But for millions of us, the reality is a daily grind, just struggling with a soaring cost of living and this constant nagging feeling of job insecurity. So let's just start with that low unemployment number, okay? On the surface, it sounds fantastic. But what it does is it hides a massive hole in the data, a hole the size of 1.6 million people. Yeah, you heard that right. 1.6 million Americans have just disappeared from the unemployment stats. Why? Because they've given up looking for work. So they're not counted. Poof. As far as the official data is concerned, they just vanished into thin air. So the core reason for this whole disconnect, it comes down to something called Goodhart's law. It's a really powerful idea. Basically, it says that when a metric becomes a target, it stops being a good measure. Think about it. When policymakers are laser-focused on just hitting a specific unemployment number, that number itself can get twisted and stop reflecting what's actually happening in the real world. And this illustrates the shell game perfectly. I want you to imagine someone you know, they lose their good, salaried, full-time job. To make ends meet, they have to scramble and take 2 part-time, low-wage jobs. Now, how do the official stats count this? They call it a net gain of 1 job. It looks like job growth on paper, but for that person, it's a full-blown financial crisis. And while the quality of jobs is going down, our ability to actually save any money, it's collapsing. The personal savings rate, it's been nearly cut in half. It's dropped from a historical average of about 8% all the way down to just 4.5%. I mean, we are all running on fumes here. And look, this isn't just a problem here at home. This thing goes so much deeper. You see, for decades, there's been this hidden global force that's been propping absolutely everything up. But now, that force, which is basically the world's ATM, is shutting down. And that force has a name. It's called the yen carry trade. Now stick with me here. It's pretty simple. For 30 years, huge financial players could borrow money in Japan for practically zero interest, like almost free. Then they'd turn right around and invest that money in US assets like bonds that paid way more. It was literally the world's free money machine. So where did this all come from? Well, it started way back after Japan's own massive asset bubble burst in '92. That kicked off their lost decades, and they were forced to pretty much superglue their interest rates to the floor. This move, this one thing, turned Japan into the financial duct tape holding the entire global system together. But now, in 2024, that duct tape is starting to peel right off. Here's a good way to think about it. For about 30 years, the entire global market was basically running on free Japanese Wi-Fi. It was this invisible, always-on, constant stream of cheap money that fueled everything, from tech stocks to real estate booms. And then the signal just cut out. In 2024, Japan did something it hadn't done in 17 years. It raised its interest rates. Just like that, the free money spigot was cranked shut, and this whole massive trade started to unwind. So why is that such a big deal? Why is it so critical? Well, the legendary investor Ray Dalio said it perfectly. The bond market is the backbone of all other markets. And right now, that backbone is under incredible pressure because its biggest, most reliable buyer for decades is starting to walk away. Okay, so you've got this global system that's starting to shake. The ground is unstable. So what are the insiders, the big institutions, doing about it? Well, that brings us right to our next section. The insider's 6-step playbook for a market crash. And trust me, this isn't some new strategy. This playbook has been run during pretty much every single major downturn. It all starts with step 1, the signal fires. Then comes the invisible exit, followed by the narrative. Then a trigger event, the liquidity trap, and it all culminates in a massive, massive wealth transfer. And here's the kicker. We are deep into step 1 right now. There's a key signal called the equity risk premium, and it's basically at zero. So what does that mean? It's the extra reward you're supposed to get for taking on the risk of owning stocks instead of super safe bonds. And right now, investors are taking on all the risk for basically no additional reward. It's a huge red flag.
And you know what? We are absolutely 100% living through step 3 right now. Just turn on the TV. The media, the financial talking heads, they're all screaming, buy the dip, stay the course. But behind the scenes, private data shows that their own institutional clients are selling off stocks at the fastest pace in over a decade. You see what's happening? They're creating a narrative to keep you in the market, while they are quietly heading for the exits. If you really want to see the truth of what's going on, you have to stop looking at the market in dollars. Instead, price it in something real, something like gold. And when you do that, the picture changes completely. Since the peak of the dot-com bubble, the S&P 500, when you price it in ounces of gold, has lost 75% of its value. Let that sink in. The gains you think you see on your statement, they're mostly just an illusion, created by a currency that's losing its own value.
So here's the crucial takeaway. All of these different threads, the bad data, the yen carry trade unwinding, the insider playbook, they are all coming together right now. What we are witnessing is nothing less than the end of an era. We are at the end of easy money.
And the scary part is, this time around, the old safety nets we're used to, they're broken. Think the Fed can just swoop in and cut rates to save the day? Not really. Not with inflation still lurking. What about that old advice, just give it time in the market? Well, that could mean waiting 17, maybe even 34 years just to break even. Just ask anyone who bought Microsoft or Intel back in 2000. And you definitely can't hide from a debt crisis by buying more debt, which is what government bonds are. And all of this leads to the harsh, brutal climax of the entire playbook. It's that awful moment of realization when the buy the dip crowd finally figures out they weren't buying a discount. No, they were the exit liquidity for the banks and the insiders. So let's go back to that feeling we started with, that little gnawing feeling in your gut that something is just fundamentally not right with this picture. Well, you're correct. This isn't some forecast about what might happen in the future. This is an explanation of what is already happening, right now, just beneath the surface. Which leaves all of us with one final and pretty sobering question to think about. When all that easy money, the financial oxygen we've all been breathing, finally leaves the room, who's going to be left holding the bag?